Welcome, traders. Let's stop talking about $2,000 or $2,500 gold immediately. That's the past. Today, I am going to present the most controversial and potentially most lucrative analysis of the decade. Gold will reach $15,000 by 2030. Yes, you heard that right. 15,000. I know what you're thinking. That's madness. But over the next 10 minutes, I will show you the data, the charts, and the three global forces that not only make this forecast possible, but make it inevitable. If you are trading gold, you ignore this analysis at your own risk. Let's dive in. To understand $15,000, we must look at history. In 1980, gold hit $850. If you adjust that price for inflation and the M2 money supply expansion since then, gold should be well over $5,000 today. But the real fuse is de-dollarization. The US dollar is losing its global reserve currency status. BRICS nations, China, Russia, they are all hoarding gold and seeking alternatives to the USD for international trade. Less confidence in the dollar means an automatic flight towards the only true safe haven asset, gold. This isn't theory, this is geopolitics in action. Now let's focus on central banks. They have one problem: debt. Global debt is unsustainable, and the only way to manage it is to print money and devalue the currency. This inflation is not transitory, it is structural and chronic. Gold is the currency with zero counterparty risk and zero expandable supply. Faced with trillions of dollars being printed, gold doesn't have to do anything but maintain its purchasing power. And in this scenario, $15,000 is simply the value it must reach to compensate for fiat devaluation. It's a simple equation. The more the currency is devalued, the higher the price of gold in that currency must go. The third pillar of the $15,000 thesis is central bank demand, especially from China and India. Central banks are the whales of the gold market. They are buying at record paces, often non-transparently, to diversify their balance sheets away from Western sovereign risk. When the world's largest institutional players accumulate an asset, the signal for traders is crystal clear. The supply of gold available for the free market, like futures and ETFs, is shrinking. Massive institutional demand combined with limited supply is the perfect recipe for a parabolic surge. Okay, the forecast is $15,000. How do we prepare? This isn't an overnight move. This is a secular trend. For the short-term trader, whether day or swing, monitor US real rates. As long as real rates are negative or near zero, gold has a tailwind. Look for long entries on retracements toward the 200-day moving average. For the investor or position trader, consider steady accumulation through dollar-cost averaging into physically backed gold ETFs. Think GDX for miners or GLD and IAU for physical gold. This strategy minimizes volatility risk. And here, S the key level not to miss. If gold breaks and closes sustainably above $2,500, the $15,000 target moves from possible to probable. That will be the confirmation signal. To sum it up, gold at $15,000 is not a dream. It is a mathematical response to monetary and geopolitical instability. De-dollarization, chronic inflation, and insatiable central bank demand are the engines of this move. You are not just investing in gold. You are investing against debt and devaluation. So what is your forecast? Do you think 15,000 is too low? Let me know in the comments. If this analysis made you rethink your portfolio, hit the like button, subscribe, and hit that notification bell. Next week, we'll analyze how silver could outperform gold in percentage gains. You don't want to miss it. See you at the next trade.